So thank you very much for the invitation to present this paper and for the kind introduction. So I watched some of the past seminars, and it's, given the past speakers, so it's a great pleasure to join this group. Right. So the paper I'm going to present is co-authored with Alex Zeidelson, who is the CEO of Secret Labs. So Secret Labs is a development entity behind the Secret Network, which is basically developing different privacy-focused, confidentiality-preserving blockchain applications, in particular in the DeFi space. Now, the reason this work is together with Alex is that we've been collaborating for quite a long time so far in developing a new kind of innovative decentralized exchange, which has been live for a couple of months now. And, this is part of it is, part of the research that we've been doing as part of doing the exchange. Now, before moving to the paper itself, I just wanted to say a couple of words about kind of the current state of DeFi research, at least as, the way I view it. So I think that DeFi in general, DeFi research in particular, is something like 3.5 years old. And, the quantity and the quality of papers on DeFi has been outstanding. But there still seems to be a little bit of market fragmentation. So most of readers of DeFi papers, are people who are kind of early adopters of blockchain technology, in either kind of academic or practical sense. And what I think we as kind of a community of DeFi researchers need. In order to break this glass ceiling of mass adoption, and here I mean in an academic sense, is to try to kind of convince the general finance audience that looking at DeFi with its unique characteristics and huge, immense, readily available data, could teach us something about other markets, and so extend what we know, in DeFi to other markets, beyond DeFi and blockchain. And so in this paper, we are actually trying to do a little bit of that, right? So we're trying to use DeFi data to try to answer a more general kind of economics or finance question, right? We'll see, to what extent we succeed here, but, but that's what we try to do. So after this long introduction, let me actually start talking about what we actually do in this paper and the research question we're trying to address, okay? And the research question is basically the relation between market efficiency and efficiency of allocating capital, and the setting is, as I mentioned, decentralized exchanges. So let me start with a quote. And the quote is by Walter Bagehot. It's about 150 years old. Walter Bagehot was the first editor of The Economist. And so what he said is the following. So he said that England's financial organization is so useful because it's so easily adjusted. Political economists say that capital sets towards the most profitable trades and that it rapidly leaves the less profitable, non-paying trades. In ordinary countries, this is a slow process. But in England, however, capital runs ends surely and instantly where it is most wanted and where there is most to be made of it, as water runs to find its level, right? So he basically is saying that, 150 years ago, England was a developed financial market where capital was allocated more efficiently than in other countries, right? And that is basically the definition of capital allocation efficiency that I'm going to use here. Capital allocation efficiency is a characteristic of a market. I put efficient with the question mark because this is exactly the question that we're going to try to address. A market where capital is assigned in a way that is most beneficial to the parties involved, right? So basically, we're going to try to see whether it is market efficiency that partially drives the efficiency of allocation of capital. Right? Okay, so why is this question important? So let me start from a little bit far away. We know for sure that financial markets are instrumental for economic growth, right? So there is tons of evidence at the country level, the industry level, the firm level, that there is a link between financial market development and economic growth. Right? That is pretty clear. What is less clear is the channel, right? Why is it that financial market development is good for economic growth? There have been few theories proposed, and in principle, it should be that financial markets should improve capital, capital allocation efficiency, and capital allocation efficiency should improve economic development, right? And the channels, theoretical ones are that financial markets improve price efficiency, they improve screening, they reduce agency problem, right? So all of that, should lead to better capital allocation efficiency, right? Now, empirically, it's not clear whether this is the case. There is some evidence, that should suggest that capital is allocated better in more developed financial markets. However, there is also evidence that less developed markets, as opposed, at least less developed kind of public markets, right, are not necessary for, decent capital allocation. Bank-based economies sometimes are also good at that, right? So basically, we are trying to contribute here to the empirical kind of part of this literature, right? Try to look at a different setting, try to see if kind of better measures of both capital market efficiency and capital allocation efficiency, right, would be able to see whether capital allocation efficiency is a potential channel behind this link between financial market development and economic growth, right? Okay, so I already said this, right? We're going to try to look at a causal relation. I'm going to talk about causality later on between one important component of financial market development, which is market efficiency, and capital allocation efficiency, and we're going to focus on decentralized exchanges of crypto assets. Okay, now in this for this audience, I don't really have to convince you that this market is important, but for other audiences, it might be necessary. And the reason is that crypto is still a tiny market, right? So the crypto market cap right now is about $1.4 trillion, and that is roughly 1% of the value of the global equity market, right? So this is not a big market. What is nice about it, though, is that there is a technology, a trading technology, that is very different in DeFi than in traditional markets, right? We're going to talk about that. It doesn't rely on financial intermediaries, and it provides tons of data, right? So, I'm going to argue that this market basically gives us a special and unique laboratory for examining this research question, right? The link and capital allocation efficiency, because we're going to be able to measure both at the degree of granularity that's impossible to do, I think, in other markets. Okay, now, again, for this audience, I'm going to do this part very, very fast, right? Both the kind of DEXs in general and, the concentrated liquidity that we're going to be using here in particular, but I'm going to spend, maybe 3 to 5 minutes, talking about this part. Right, so if you look at traditional exchanges, right, NYSE or NASDAQ, right, they all rely on order books and active market making. Same for centralized exchanges in crypto assets such as Binance or or Kraken or whatever. Now, decentralized exchanges are obviously built on a totally different technology that's called automated market making, or AMM, which basically works very simply. There is a liquidity provider that puts money into a particular pool of usually 2 assets, right? And then traders can basically take one asset from the pool by supplying the other, right? And there is a predetermined formula according to which they're going to do it, right? And so there is, at the level of trade, there is actually quite a lot of certainty about the outcome of a trade, right? Differently from a typical kind of order book trading. And we're going to distinguish in our kind of research the 2 types of traders. The first one is liquidity traders. The second one is arbitrageurs, which in this setting are typically called MEV, or maximum value extraction bots, right? We're going to use this distinction in building some of the measures. All right, the way it works again, so, liquidity providers provide liquidity to a pool, and traders can go along the curve and trade against it. The graph here is just an example of a particularly simple trading curve called the constant product curve, and it exhibits all the characteristics that it should be, right? The price, in fact, is increasing in the amount of trade, right? So it looks like an order book. It's just deterministic for the most part, and whereas order book is not. Okay, now there's some trade-offs, for liquidity providers. They receive fees, from trading. They're exposed to so-called impermanent loss. I'm sure that other people have talked about that in this seminar, so I'll skip it. Okay. I'll also skip, the optimal design of trading curve, right? We're going to use the design that's out there. We're going to use what's called Uniswap v3. I'm going to talk about that in a second, right? But there are some interesting issues in optimal design of trading curves. If we had more time, we'd probably talk about that as well, right? That's an example of trading, right? Let's go to concentrated liquidity provision. I think it's actually more interesting. So the idea here is that if you think about a normal trading pool, right, most of liquidity is idle most of the time, right? The rule of thumb is that the price impact of a trade is roughly proportional to the value of the trade relative to the value of the pool, right? And so nobody is going to trade with a 10% price impact, right? And so really there is not much sense of having liquidity throughout the whole range, right? Because in most of the range trades are not going to happen, right? And that's basically where concentrated liquidity comes in. That's basically an option to concentrate your liquidity. Those rays that go out of zero in this picture here, right? And that basically means that this liquidity is going to have a bigger kind of bang for the buck within this range of the exchange rate, but it's going to be idle outside of this range, right? So and that also means that concentrated liquidity needs to be rebalanced once in a while to make sure that it's basically placed in the relevant kind of range of exchange rates, right? But the good part is that in the relevant part, a given level of liquidity creates a higher virtual liquidity and smaller impact of trades, price impact of trades, within this range, right? So in this example here, there are two liquidity providers. One provides non-concentrated liquidity. The other provides concentrated liquidity. And so, again, within this range of exchange rates, we have, this kind of green line that disconnects from the rest of the curve, and within this range, right, the price impact of trades is going to be smaller, right? And so in this example, there is, a 2.33 realized liquidity concentration, meaning that, kind of we're getting, 133% higher, liquidity or perceived liquidity, right, or virtual liquidity than there exists in reality, and traders basically benefit from it. Okay. On the other hand, it might happen that liquidity goes out of range, right? Like in this example here, right? That basically means that this kind of liquidity, the green line run to the right of the graph, is completely idle, right? And we have a bad liquidity concentration. Any number less than 1 is a bad one, right? So the liquidity would have been better used if it was non-concentrated and allocated to the whole range, right? So that's basically kind of the introduction to concentrated liquidity. We are going to use concentrated liquidity data in building our measures, so that explains the last few minutes. Okay, let's talk a little bit about the data. So our data
ask you
is
a question?
Of course.
So what's your opinion about, so as you mentioned, in order to provide liquidity in version 3 in an efficient way, you need always to update your range, right? So what your thoughts about for liquidity providers, it's feel that relative to V2, it's become, you need to be more strategic, and it's maybe more costly to provide liquidity. So the question if it's not going to create kind of issues in terms of monopoly or something, like only specialized liquidity providers will provide liquidity in an efficient way, and all the entire small agents will just like get out of this market. And my question is, what's your opinion about this specific aspect?
Yeah, no, so for sure, you're exactly right that it definitely requires a much higher degree of sophistication, that's for sure. On the other hand, DeFi is one of the most kind of innovative and efficient markets out there. And, in every market, where there is demand, there is supply, right? So right now there is supply of services for automating this, concentrated liquidity allocation and also rebalancing. So there are services such as Gamma or Algebra, which are basically they're protocols that have kind of pools, right, where you put the money, right, and they do all the rebalancing for you, right? They claim that they do it in an efficient way. It may not be the case, but they're definitely doing something, right, in order to try to optimize for you the trade-off between the fees and the permanent loss and the gas, right? So I'm sure that those services are going to improve over time, right? And if they do, the less sophisticated investors could just use those intermediaries to participate in V3 ecosystem. But I agree that to do it directly, manually it's very, very hard, and not everybody can kind of build automatic tools for it.
Yeah. Actually, it's a good point. Yeah, it will be like staking pools. It will basically going to be that intermediaries will offer this service and small agents will.
Right.
Yeah.
Right. It's still so it's it's kind of a little bit besides the point, but it's not very consistent with the whole kind of ethos of DeFi, right? Because in the background, those agents, they do some sort of offline kind of or off-chain optimizations, right? So it's not all kind of on-chain, what exactly they're doing, but I'm sure this market is going to figure it out.
Thanks. Good point.
Yeah, so the data that we are using here is basically all trades in all concentrated liquidity pools. So those V3, which stands for Uniswap V3 version 3 pools, not just by Uniswap, but by all of its clones, right? So all concentrated liquidity pools that exist out there are going to be on our data. And we do this on two blockchains, on Ethereum and on Polygon. The reason we use two blockchains, and we might actually use more in the future, is that we want to make some causal inferences, and for that, we want some exogenous shocks, right, to market efficiency. We use one shock in this version of the paper that I'm going to discuss, hopefully. But we envision that we might find some others, right? And so different blockchains can serve as control samples for others that that undergo some changes, right? And so for now, this is the reason for doing this. So the data basically is from the first day. The first V3 pool was established on Uniswap, which was May 6, 2021, about 2.5 years ago, until mid-September. That's basically where we stopped the data for now, but we are constantly extending it. Now, this data is actually not very easy to work with. It's hosted on Google BigQuery, and there is a so-called blockchain ETL project that extracts all this data. Now, this data is not in a great kind of very usable form. It's kind of binary data, and so you need to write the code to translate this raw data into different blockchain events, such as trades, mints, which is liquidity provision, and burns, which is liquidity withdrawal. So that's done. And basically from that, we identify both individual transactions that happen in those pools, and we also combine them to try to see basically whether different individual transactions constitute different legs of the same transaction, right? So if you want to do, for example, a triangular trade, right, exchange USDC for whatever Matic, right, using a USDC WETH pool and then WETH Matic, right, we're going to basically see this, right, and have this in our data set. So overall, in those 2.5 years, we have something like 50,000 pool weeks on Ethereum, and that's about 30 million transactions. And about half that amount of pool weeks on Polygon, because it basically started later, but more transactions. So on Polygon, there are more transactions that are typically smaller. And so overall, we're having close to 80 million transactions in the data set. And we also have used some data from external sources, some price data from CoinMarketCap, and gas price data from blockchain explorers on Ethereum and Polygon. Right? Okay. A little bit of summary statistics. I can talk kind of a lot about those numbers, but we'll do it relatively briefly. So the median size of pool on Ethereum is about $350,000. The mean is about 4 million. The largest pool is slightly over $1 billion. It happened at one point in time, during the boom in the beginning of 2022. Pools on Polygon are smaller. So the median pool is $15,000 and the mean is slightly less than a million. Same goes for transaction volume. Transaction volume is higher on Ethereum, but there are more transactions on Polygon, right? So the mean number of transactions, all the statistics are within a pool week level, right? So the mean is about 1,000 transactions in a pool week on Polygon and about 300 transactions on Ethereum. But the average transaction size, as I mentioned, is much larger on Ethereum, about $7,000, the mean transaction on Ethereum versus about $240 on Polygon. Relative to the value of the pool, to total value locked or TVL, it's about 4 basis points on Ethereum and 3 basis points on Polygon, which basically makes sense, right? So we said that the price impact is roughly proportional to roughly equal to the to the transaction size relative to TVL. So the price impact of a typical transaction is about 3-4 basis points that that actually makes 30-40 basis points. I misspoke, and that makes sense. All right. We also measure things like standard deviation of the exchange rate of the pool's assets, right? We're going to use this. That's quite an important metric that we're going to use. And we also are going to look at gas price. You can see that it's orders of magnitude larger on Ethereum than on Polygon. That's something that everybody knows, right? But this is just a quantification of this. All right. What do we see? Oh, of course.
Can you? So, the average transaction size is also in a US value, right?
It's in dollars, yeah.
Yeah. Okay. Great. And do you also have information about wallet addresses? Because I know that you also have one paper about, all the idea about manipulation and wash trading. We know that it's already was in centralized exchanges. Do you think there is also a kind of this issue in those pools that people, pump transactions
volume, yeah.
pool? Yeah.
I'm confident there is this issue. There is, what I have is only anecdotal evidence. So I don't want to no real kind of smoking. Now, it's a little bit dangerous to do this, right? In DeFi, right? Because basically, when any trade obviously changes the exchange rate, right? So you need to bring it back right away, right? And sometimes you might not, be the first to do this, right? So you're always putting yourself at risk. Having said that, for smaller exchanges that are just coming up, where kind of MEV bots are still not, operating, it happens all the time. So up and coming DEXs pump their volume all the time. It's actually, I think it's an interesting question for a thorough investigation, and clearly there are wallet addresses, and it's to a certain extent definitely doable.
Yeah, it makes sense. Yeah, I guess it more in small pools or new pools that just launch.
Yeah, for sure.
Good. Okay, thanks.
All right. So I showed you kind of an average kind of snapshot, right? So these graphs show a little bit of the evolution of some of those variables over time, right? So the blue graphs here are for Ethereum, and the red graphs are for Polygon, right? So right now we basically see that there are about 300 or so pools on both Ethereum and Polygon, right? And this number kind of stabilized in the last half a year or year or so. TVL over time, now we are not kind of at the best times in DeFi. Maybe times are getting slightly better, but up to September, right? We've seen a reduction in TVL. So the overall TVL in V3 pools on Ethereum was slightly over $1 million at the end of the sample, and about $300 million in on Polygon, right? Hopefully those numbers are going to go back to the glory of kind of the beginning of 2022, but we'll see about that. Same goes for the volume of transactions, right? Now, what's interesting here is that kind of the number of transactions has sort of steadily gone up on Polygon, not so much on Ethereum, right? But this is just kind of descriptives. So what I want to do now is I want to talk a little bit about how do we actually construct those measures, right? Both capital allocation efficiency and market efficiency, and then we're going to connect the two. So our measure of capital allocation efficiency is capital market based, right? And that's different from existing measures that typically rely on the sensitivity of some sort of corporate investment, different kinds, to some measure of profitability in investment. Think about Tobin's Q of sorts, okay? And our measure also, as I mentioned, is going to be very granular. It's going to be estimated at the blockchain time, which is week, and pool level, right? And that's why we're going to have about 75,000 observations all in all. All right, so how do we do this? So we do the following exercise, right? The first part is just measurement, right? So we take a given V3 pool, concentrated liquidity pool, in a given week on a given blockchain, and we just measure an average TVL of this pool throughout the week, all right? And we kind of remember this number, okay? And also for every trade that we observe in this pool during this week, we're basically measuring the amount in, how much people sent to the pool, and the amount out, how much they bought, from the pool. Okay, that's the simple part. And then we do the following kind of mental exercise. We're saying the following thing. Let's assume for a second that there was a V2, a traditional non-concentrated liquidity pool, right, with the same asset, right? And let's basically just assume some values of each of the two assets in this non-concentrated liquidity pool, right? Let's just start with some numbers, right? And let's run the same trades, right, through this non-concentrated liquidity pool, right? We're going to run the same amount in and see what is going to be the amount out in this hypothetical pool that we pretended to exist, okay? And so for each trade that actually happened in this pool this week, or in the corresponding actual V3 pool this week, we're going to measure this hypothetical amount out, which, I use this tilde, right, to denote it. Okay? And then for every trade, we're going to compute the difference between the actual amount out that happened in V3 pool and the hypothetical amount out that would have happened in the non-concentrated liquidity pool, right? So this absolute difference between this hypothetical amount out and the real amount out that happened, right? We're also going to multiply this difference by the price of the amount out to get this difference in dollars, okay, at the time of the price at the time of the trade, right? And we're going to normalize it by the realized dollar price impact of the trade, right? And that is basically kind of to be able to use both large trades and small trades in this kind of exercise that we're going to do. Okay, so think of this as basically the distance between the amount out that would have happened relative to normal, normalized by the size of the trade, if you want to put it, right, or the price impact of the trade, right? Now, this ratio, I'm going to show the formula in the next slide, but this is basically the estimation error for a given trade when we assume some hypothetical balances of the two assets in the non-concentrated liquidity pool, right? Now, the actual exercise is to try to find these balances that minimize the sum of estimation errors for this pool during this week, right? Kind of to try to find the V2, the non-concentrated liquidity pool, as close in essence to the concentrated liquidity pool, right? When we do this, we're going to be able to compare the hypothetical liquidity in the V2 pool to the actual liquidity in the V3 pool, and dividing by the other is going to give us the liquidity concentration, right? Basically, the bang for the buck, right? The capital allocation efficiency. Here's the actual measure, right? So here in the numerator, we have the dollar difference between the hypothetical and real amount out, okay? In the denominator, we have the normalization, okay, by the actual price impact of the trade. And we are minimizing the sum across all trades in a pool in a week, right, with respect to the hypothetical amounts of the two assets in the V2 pool. Okay? And we do this exercise, 75,000 times, right, using this 80 million trades, right? And we get, this measure of capital allocation efficiency at the pool week level, which is basically the size of this hypothetical, the TVL of the hypothetical V2 pool, relative to the actual TVL average throughout the week of the V3 pool that we observe, right? The higher this number, the higher the capital allocation efficiency in the pool.
Can I ask a question?
Of course.
So just to clarify, so basically the idea is when you do this, the V2 hypothetical pool always going to be have a higher liquidity lock than
No, not always, because sometimes the liquidity in V3 pool is idle, right? It's out of range, right? In that case,
okay, yeah,
you'll need less liquidity in V2 pool to get to the same result.
Yeah, okay, yeah, good point. But like, I mean, like,
I'll show you some summary statistics. So on average, you're right. So typically, the hypothetical TVL in a V2 pool is going to be larger than in V3, but not always.
And the idea about the capital allocation efficiency is that given that V2 in those cases, you need to provide more liquidity, which not really going to be used. So it's going to be inefficient because you can achieve the same trading
Outcomes with this
with lower liquidity.
Exactly.
Can I ask? So here
Of course,
when you
definitely
estimate X V2 star and Y V2 star, that's at a week level, right? That's at a weekly level.
Yes. Yeah.
How big of a change or how big the impact is when we think about the interval of the estimation? Because we can think about if a pool does have a lot of liquidity position change in a week, then maybe this is gonna be more noisier than if we make it at day level.
This is a great point, and we'll see. I'll show you one of the tables that show exactly this, right? So I basically, one of the kind of preliminary tests is we're going to see how well, how big this estimation error is, right? How well we're able to approximate, V3 with V2, and the quality of approximation is worse when, for example, there is large volatility in exchange rates. When prices fluctuate a lot, we are not able to estimate this as well. All right, so this is definitely true. So the trade-off here is basically, I would like to do it at as short a frequency as possible, right, or as short a period. However, I need a decent number of trades, right? So we put a limit of say 30 trades in our exercise, right? So we only estimated in pool weeks with at least 30 trades, right? And clearly, there are going to be fewer pools if we're going to do it on a daily basis. But that's the trade-off. And we can repeat this exercise. It's a little bit costly time-wise. So this thing, like estimating the whole thing, took about a month. Just running the code. But we can do it. All right. So a little bit statistics about capital allocation efficiency. The first line here in each of the two panels is the mean estimation error, right? So in every pool week, we have a mean, and then we provide a summary statistics on this means, okay? And so the typical estimation error that we get is between 1 to 2%. Right, so I'm not really, I don't know what the right benchmark, right? Whether this 1 to 2% is a big number or small number, but it's normalized by the size of the trade, right? So it seems decent, right, on average, right? So we're off, in terms of the relative price impact is off by roughly 1 to 2%. Seems okay to me, but it's in the eye of the beholder. Now, capital allocation efficiency is a little bit actually probably more interesting. So the median capital allocation efficiency is about 6 or 7 on both Ethereum and Polygon, right? Those seem kind of reasonable numbers to me, right? So basically, kind of you put the liquidity in about 15% of the range. The mean is much higher, right? So the mean is 215 on Ethereum and about 1,000 on Polygon, right? The reason it is much higher is that basically in stablecoin pools, right, capital allocation efficiency is very large, right? So you can reach thousands there because you really need to provide liquidity between 0.99 and 1.01, right? And no trades happen outside of this range, right? So you get to very high capital allocation efficiency, right? So the maximum is 38,000 on Polygon or 6,000 on Ethereum, and those is precisely in stablecoin pools. Right, so that's kind of the statistics about the capital allocation efficiency. That's the evolution over time. So this is in logs, right? So the log capital allocation efficiency is plotted for both Ethereum and Polygon. What you see initially, so Polygon started later, in about 30 weeks or half a year later than Ethereum. you see that in the first week, there was only kind of 1 or 2 stablecoin pools, hence the large, capital allocation efficiency initially, and then other pools were introduced and they kind of converged to roughly the same area. All right, so I promised to talk a little bit about what determines the precision of estimation, right, or estimation errors, right? And so there are 3 things really that affect it. The first one is the number of transactions, right? So the more data we have in a pool week, the more precisely we are able to estimate. So the smaller the estimation error, meaning that more precisely we can estimate kind of this correspondence between V2 and V3 pools, right? Transaction volume. So the larger the trades, the easier it is kind of to estimate the price impacts, right? So kind of the more precise the estimation is. So that's also sensible. Now, what's bad for estimation is, as I said, the standard deviation of the exchange rate, right? So for more volatile pool, prices move a lot, right? And so our kind of estimation using average weekly prices or average weekly pool sizes, right, is just not precise enough, right? So, the higher the volatility of the exchange rate, the worse the estimation, right? And I should have mentioned that we only use pool weeks where the average kind of estimation error is less than 10%, right? That explains the max here, the 9.998 and the 9.993. We basically throw all the pools where we cannot estimate well or relatively well the kind of the correspondence between concentrated and non-concentrated liquidity. Okay. Now, let me say a few words about measuring market efficiency, right? That's the second component, right? And then we're going to connect the two. So here we basically go back, 50 some years, right, to FAMA, right, to basically the efficient market hypothesis, right? And what the efficient market hypothesis say? Well, inefficient markets, anomalies should not exist because they're immediately arbitraged away, right? Now, this might be a theoretical concept in traditional markets, but it is real in DeFi, right? So arbitrage is usually arbitraged away right away, meaning either the same block, the same second, or maybe the next block, right? But very, very fast. And so our measure is going to be decentralized exchange specific, right? Basically based on proportions of efficiency restoring arbitrage out of all transactions in the pool, right? So I said initially that we're going to separate kind of noise trading or liquidity trading from arbitrage trading, right? And we're actually going to focus on one particular type of arbitrage, which is efficiency restoring arbitrage. I'll talk in a second about what that means. The more of it is in the pool, the more efficient the pool is. The faster prices go back to what they should be, right? The faster the arbitrage opportunities are basically eliminated. And I'm also going to show you that this measure is going to have a lot of variation cross-sectional, time series, and across blockchains, right? So lots of kind of empirics that can be done with it, right? But let's first talk about how we do this, right? So we first try to find efficiency restoring cross-pool. We call this positional arbitrage, right? And that is basically transactions that have multiple legs submitted to the blockchain together, right? Whose idea basically is to exploit price differences across different pools, perhaps in different protocols, right? So this is one example here. It's basically a 3-legged arbitrage. One leg is done on Curve, the other 2 are done on Uniswap P3. I'm not going to go through the numbers, but it is a very successful arbitrage where a person was able to exploit the differences in prices, implied prices due to pool compositions, and gain something like 16 Ether, right? Something like whatever, $30,000 in this case. Okay, so we basically look for all transactions like this. There are conditions that we're trying to basically see, and the condition basically is that it's a bulk transactions, so multiple legs submitted together, where all the amounts in are non-negative, right? And there is some positive amount out, right? So basically a successful arbitrage involving at least 2 legs. There is also other type of arbitrage in this market, which is not good for our purposes, right? We're calling this a non-efficiency restoring arbitrage. This is sandwich arbitrage or sandwich attack, right? That is basically front running and back running a transaction, right? So you see a transaction in the memory pool, you have an agreement with a block builder that is going to put your front running transaction just before the transaction in the memory pool. and your back running transactions just after it, right? And you're going to just basically exploit, that person. It's an arbitrage, but it's not efficiency restoring, right? We're not kind of moving the prices to where they should be based on the efficient market hypothesis. We're just basically creating a value transfer from this kind of benign transaction to the arbitrageur that is exploiting it, right? So we're going to measure the sandwich arbitrages as well, and we're going to control for it, right? Because it's important, right? We're going to basically, because sandwich arbitrage basically kind of proxies for the degree of sophistication of traders in the pool, right? So we want to make sure that when we uncover the relation between capital allocation efficiency and market efficiency, it's not due to just the sophistication of the traders. It's actually due to market efficiency restoring arbitrage, right? All right, a little bit of statistics on both types of arbitrage, right? So on Ethereum, about 15% of trades are part of efficiency restoring arbitrage, right? And between 2 to 6% of trades are sandwich arbitrage, right? The numbers are somewhat different on Polygon. There is more positional efficiency restoring arbitrage and less sandwich arbitrage. And we also control for other bot trading. So most of the transactions on the blockchain, or part of them, are basically labeled, right? And some of them are labeled as basically bots, right? So we want to also control for other non-arbitrage bot trading, because basically bot trading can be associated with informed trading, right? And we want to see that whether kind of market efficiency or capital allocation efficiency is affected by the likelihood of trading against informed trading. The prior is that it should be negatively affected. We'll check that. Okay, so those kind of are the three measures that we construct using blockchain data that we are going to use in the analysis, but the focus is going to be on the first one, this percentage of efficiency restoring arbitrage. This is the evolution over time. Oh, sorry.
We have a
Yes.
question in the Q&A. It says, like, wouldn't it be the case of the less restoring arbitrage, the more efficient it is? Suppose the market is always efficient, then the less restoring need means that more time that it already is efficient.
Well, it's kind of chicken and egg, right? So the markets are not born efficient, right? So let's say that there are two pools, with the same assets in two different DEXs, right? In two different markets, right? And a trade happens on one of them, right? So that means that the prices now are imbalanced, right? And the only way to restore the prices is through arbitrage, right? There's no other way. I mean, there could be some noise trade that happens to happen on another exchange that brings the prices together, but that's less likely, right? So it's most likely that kind of the prices are restored back to efficiency through some sort of arbitrage transaction, right? So the markets cannot kind of remain efficient, without any action by the arbitrageurs. All right, so this is the evolution of this efficiency restoring arbitrage over time. It's pretty stable, give or take. It's slightly higher on Polygon than on Ethereum most times. All right, let's now talk about kind of the subject of the paper, and that is the relation between market efficiency and capital allocation efficiency. I have like 6 or 7 minutes, right? Okay. All right. So let's see. Okay. The first thing is just kind of a simple kind of panel regression, right? Where it's not no identification, right? Just establishing some correlations, right? So basically, what we do is the dependent variable is our measure of capital allocation efficiency. The independent variable is this percentage of efficient restoring arbitrage. That's the second line in this table, and we control for a bunch of things, sandwich arbitrage, non-arbitrage bot activity, and a lot of other characteristics. I don't have time to go over them, but I want to focus on the important line here, right? We do it on Ethereum, Polygon, without fixed effect, doesn't matter, right? We always get that there is a clear positive relation between market efficiency and capital allocation efficiency. Again, no causality yet, but just some association. Okay. Let's talk a little bit about causality, right? So so far we just use one shock that we think can be used as an exogenous shock to market efficiency. I'm going to describe this in a second, right? But we're looking for more, right? This is a very early stage project, and so any ideas would be very very welcome. So let's do 1 minute of history, right? The shock is going to be on Ethereum blockchain, right? So let's kind of talk a little bit about the history of Ethereum. So up to September 2022, Ethereum was a proof of work consensus blockchain like Bitcoin, right? And then the so-called merge happened on September 5th, 2022, which was a transition to proof of stake. Okay. Now, why is this interesting for us? It's basically because we want to look at this ecosystem of arbitrage that is basically done by this relation between three parties: the bots, right, that basically find arbitrage transactions, to block builders who construct the blocks by basically kind of trying to find or to choose the most profitable transactions, because the bots are giving most of their income to the block builders. And the block builders basically turn the constructed blocks to block validators who submit this to the blockchain. Okay, all of those parties basically get some share of the surplus to be generated from the arbitrage trades. Now, for this to happen, right, you need a working relation between bots, block builders, and validators, and this working relation is off-chain, right? Those are some agreements about the the share of the surplus that are made somehow between those parties. Okay. Now, what the merge did was it basically changed to a certain extent the identity of the validators, right? It used to be mining pools before the transition to proof of stake, and it basically became so-called staking pools, right? So stakers to the blockchain are, have become the validator, right? And those are not necessarily the same people, okay? However, this was all expected, right? And we expect, and we actually see in the data, that nothing really happens around the merge, right? And that is probably because there was enough time for the block builders to construct working relationships to the new type of validators, right? That's actually a very interesting illustration of this idea, right? And the difference between Ethereum and Polygon. So those pictures basically show the amount of arbitrage profits on either of the two blockchains based on the location of the transaction inside the block, right? So the big red circle on the left is the zeroth transaction, so the first transaction on the block, right? Most of the profits, right, happen because the block builders, are willing to put arbitrage or any profitable transactions in the first place of the block, right? Meaning that it's not random, right? If everything was random, you would expect kind of an even distribution of trade profits across all locations of the block. That's not the case. It's much more the case on Polygon, right? So on Polygon, this whole ecosystem is much less developed, right? So this is data from about half a year ago, but I imagine it's still the case. Okay, so this is just an interesting illustration of this, right? But where I'm going with this is that the merge was probably not a great natural experiment. There is another one, right? And the one that is better, I think, is the so-called Shapella upgrade of the Ethereum blockchain, right? That happened, about half a year ago in April of this year. Part of this upgrade was allowing the unstaking or withdrawing of staked Ether from the blockchain, right? And that actually happened to create a large disruption to the identity of main validators, right? And this disruption was largely unanticipated, right? Because it was clear that people would unstake Ether. It was not clear who would do this, right? So a lot of the working relationship with validators was expected to be disrupted temporarily, right? But the expectation actually, was borne out in the data. Okay. Now we're going to use Polygon as a control sample, right? And Polygon has always operated using proof of stake consensus and with much less of those games between block builders and validators and MEV bots, so it seems to be a decent control sample, right? So that's basically the diff and diff that we're going to do, right? So very simple diff and diff. We have the post Shapella, right? That's the event. The Ethereum dummy, right? That's the treated dummy, and the interaction, right, between them, and that's basically the line that I'm going to want to look at, right? And clearly there is a negative relation here between capital allocation efficiency and a shock to the market efficiency, right? So a negative shock to the market efficiency created a reduction in the in the degree of capital allocation efficiency in the affected blockchain, in affected pools. We do a bunch of different definitions of windows, right? I don't have time to go over the details, but I think the the result is quite striking here. You can actually see it very vividly on the graph as well. I should have put the graph here, but it's actually very, very clear. All right. So well, I guess 1 minute left. So what we do here, we have developed novel measures of both capital allocation and market efficiency in the context of decentralized exchanges, right? We found that concentrated liquidity tends to, on average, lead to significant improvements in capital allocation efficiency, but there is quite a lot of cross-sectional variation there. The main finding, right, and this is kind of the selling point of this paper, is that market efficiency does seem to positively impact capital allocation efficiency, but we're looking for more exogenous shocks to basically solidify or refute, this finding, right? Now, we want to think that this is a general implication, right? The reason is that I don't think that there is anything special in this data, right, that would kind of hurt the external validity of the findings, right? And that they won't extend to other markets, right? So clearly we can't measure those things in other markets, but I think that the findings, could extend to other markets as well, right? And that basically means that, we should strive for more market efficiency, right? Because there is a channel, right? There is a channel from market efficiency to efficiency of allocation of capital to economic development and growth. And clearly this is something that all of us, care about. Future research, we are extending the data both in time and to other blockchains potentially, with the goal of trying to find additional exogenous shocks. There is also a big part of this project that we are going to work on, and that is to estimate optimal capital allocation efficiency relative to the existing one, right? Clearly nothing in the world is optimal. We want to see how smart or stupid the liquidity providers in B3 pools are, and also relate these deviations between observed and optimal allocation efficiency to market efficiency measures that we provide, right? That basically is it. I'm going to finish 15 seconds with something that is tangentially relevant. I'm an editor of Journal of Corporate Finance, and there is a JCF special issue of blockchain-based finance coming up. It's co-edited by Alfred Laird, that I believe presented in the seminar, some weeks ago, Christian Parlor, and myself. It's going to be a combination of some invited review articles and submitted contributions. The deadline is in exactly 2 weeks. You can look at this SRN announcement. So everybody who is in the area and watching this, I strongly, advise you to submit to the special issue. Thank you.